do you see stresses, strains, anything similar to what we saw in the UK last week, whenever that was? Everything's sort of mushing together. I think it was last week.
It was last week. It does feel like it's all blending together. There are a few strains in the U.S. markets. I would say that last week, again, on the tail end of some of that instability in the UK, we saw mortgage spreads gap way wider. So that was one bit of instability. I think they've since recovered as global rates have recovered off their highs. But I think that all this stuff is connected at the end of the day.
I just wonder, Mimi, that if you stay at zero for a long time, and we can date it, if you want to date it to during the pandemic or go all the way back. I mean, we've been in emergency mode with QE and everything else for more than a decade. If the absolute level where we head on interest rates doesn't seem historically that high, does the speed at which we get there, can that cause really serious things or not?
Yeah, first of all, the speed we got there is really crazy. To put it in context, 10-year real yields have moved from minus 1% to north of positive 1.5%. So we've seen a 2.5% more than that move this calendar year. And in the context of overall basket type portfolio stocks and bonds, typically the bond portfolio bails out the equity side of the portfolio when equities aren't doing well. And this year that hasn't been the case. But to answer your question about with these rapid moves, can things break? Yes, absolutely. I mean, the UK pension fund experience is a good one. Just to refresh your memory, your viewers' memories, UK 30 years went really rapidly to north of 5%. And from the news articles, at least they suggest that the LDI, like the folks helping those pensions in the UK hedge their long-dated liabilities, had interest rate swaps on.
I mean, I don't know why. We don't have that much time, Mimi, but I got one last question. So if the Fed is dead set on inflation and fighting inflation, and they say, look, I'm not going to even, do they need to see the whites of the eye of a credit event for them to stop? Or would they just go head first, another 75, if inflation stays hot, another 75, and then another 75 after that? Or do they consider things like this, that we're moving too quickly? What do you think?
Only market function, not level. I don't think they'll care about the level of interest rates, credit spreads. They're trying to tighten financial conditions.
So they'll wait they need an actual market problem before they would slow. So it just seems like, it's like we're going to bend this thing. If it breaks, then we'll stop. That sounds like not a great way to conduct policy.
They really are full force inflation fighting along with global central banks. But I think the Bank of England is a good example. They did step in when there were market function issues. Right. So that's what we should be looking for.
Okay.
Shepard Smith here. Thanks for watching CNBC on YouTube.